Welcome to EZIKAN Academy YouTube channel. In this session of EZIKAN Academy tutorial, I will examine IFRS 2, share-based payments. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, thank you for being part of this channel. So, share-based payments. IFRS 2 explains the accounting treatment for share-based payment transactions. IFRS 2 explains how to account for share-based payments transactions. A share-based payment transaction is a transaction in which an entity receives goods or services as consideration for equity instruments of the entity. A transaction in which an entity receives goods or services as consideration for equity instruments of the entity, or a transaction in which an entity receives goods or services from a supplier by incurring a liability to the supplier for an amount that is based on the entity's share price. So, a transaction in which an entity receives goods or services from a supplier by incurring a liability to the supplier for an amount that is based on the entity's share price. That is share-based payment transactions. So, types of share-based payment transactions. Basically, in accordance with IFRS 3, there are three types of share-based payment transaction. Number one is equity settled share-based payment transactions. Equity settled share-based payment transactions. Number two, we have cash settled share-based payment transactions. Cash settled share-based payment transactions. The third one is the one that is a combination of equity settled share-based payment transactions and cash settled share-based payment transactions. That is, transactions where an entity acquires goods or receives services, and either the entity or the supplier can choose one, a cash amount based on the price of the entity's share. Number two, equity instruments of the entity. In this video, I want to start with equity settled share-based payment transactions. Equity settled share-based payments transactions. So, equity settled share-based payment transaction. This is where the entity pays for goods or services by issuing equity instruments. Where the entity pays for goods or services by issuing equity instruments, which include shares and share options. The equity instrument may include shares and two, shares option. I've told you equity settled share-based payment is where the entity pays for goods or services by issuing equity instruments, which include the shares or shares option. Recognition. Recognition means incorporating an element into the financial statements. When you incorporate an element in the financial statements, that is the meaning of recognition. So, Goods and services must be recognized when they are received. So in a share-based payment transaction, when goods or services are received, they must be recognized. So when you are recognizing the good, or when you are recognizing the goods or services, you may either recognize it as an asset or as an expense, depending on the nature of the transactions. I've told you in a share-based payment transaction, so when goods or services are received, you should either recognize them as an asset or you recognize them as an expense. I've told you the criteria for recognition depends on the nature of the item. So if it is goods, so that means you are having an asset. If services are rendered, so you pay for the service, that is an expense. So that is why I say it depends on the nature of the transactions. So it is the nature of the transaction that will determine whether the goods or the services should be recognized as an asset or as an expense. For equity settled share-based payment transactions, so for equity settled share payment transactions, I've told you, you recognize either asset or expenses. So you debit assets or expenses and you credit equity in the statement of financial position. So this is the accounting entries required. So you debit an asset or expense and you credit the equity. So we want to look at the measurement of equity settled share-based payment transactions. Measurement of equity settled share-based payment. Share-based payment transactions. So by measurement, we mean the basis used in determining the monetary amount at which an element should be recognized. So I am looking at the measurement of equity settled share-based payments transactions. There are two methods of measuring equity settled share-based payment transactions. Number one, we have direct measurement method. Direct measurement method. And the second method is indirect measurement method. Indirect measurement method. These are the two methods of measuring equity settled share-based payment transaction. But before we go into this, we want to examine the terminologies that will be used in connection with this. So number one, we have measurement date. Measurement date. Measurement date. Measurement date is the date at which the fair value of the equity instrument granted is measured. The date at which the fair value of the equity instruments granted is measured. That is measurement date. Number two, we have grant of shares. Two, grant of shares. Grant of shares. The market price of the share is usually used to measure its value at the grant date. Number three, we have vesting condition. Vesting conditions. Vesting conditions. These are the service conditions required before the options is vest. Before the option can vest, those service conditions that must be satisfied before the option can vest. Those conditions are what we refer to as vesting conditions. They are the service conditions required before the options can vest. Example, XPLC is a company with a 31st December year end. On 1st of January year 1, XPLC grants 100 options to each of its 500 employees. Each grant is conditional upon the employee working for XPLC over the next 3 years. At the grant date, XPLC estimates that the fair value of each option is $15 required. Calculate the income statement charge for the year ended. 1. 31st December year 1. If at that date, XPLC expects 85% of employees to still be with the company at the end of the vesting period. 2. 31st December year 2. If at that date, XPLC expects 88% of employees to still be with the company at the end of the vesting period. 3. 31st December year 3. If at that date, 44,300 share options vest. Solution to the question. The name of the entity is XPLC. XPLC. So you were told the year end is 31st of December. So now let's have year 1. Year 1. Remember, I've told you that the double entry for the recognition of equity settled share-based payment is to debit the assets or expenses and credit the equity. So now, if you look at this, is this going to be an asset or an expense? You were told on 1st of January year 1, XPLC grants 100 options to each of its 500 employees. This is a settlement to employees. So it is an expense. So because of that, we are going to debit the expenses, then we will credit the equity. Now, December 31st. As at December 31st, year 1. So how much? What will be the expected outcome at the grant date? Expected outcome at the grant date. If the grant date, so if you go by the first option, 31st December year 1, if at that date, XPLC expects 85% of employees to still be with the company at the end of the vesting period. So the vesting condition, the vesting condition is for the employees, 85% of the employees to still be with the company. So if 85% will still be with the company, what is the total number of employees? You have 500 employees. 500 employees. Then of these 500 employees, you expect 85% to still be with the company times 85%. Then, what is the share options? On 1st of January year 1, XPLC grants 100 options multiplied by 100 share options. And at what price? I've told you the market price should be used. This question is obtained from BPP ACCA study test. And this same question is in ICAN study test. So at the grant date, XPLC estimates that the fair value of each option is $15. So the fair value is $15 multiplied by 15. So this will give you the amount that will be charged as an expense for the period. Now, how many years is involved? Employee working for XPLC over the next 3 years. You know, this is year 1 out of the 3 years together. So you now have times year 1 out of 3 years. So we have 500 employees, 85% of that, it gives us 425 employees. Times 100 options, you have 42,500 times 15 divided by 3. That gives us 212,500. This 2,500 will be charged as an expense in the statement of profit or loss. 212,500. This will be charged as an expense in the statement of profit or loss. We now have year 1 charge. No, I've told you debit the expense with the sum of 212,500. So you debit the expenses with 212,500. Then at the same time, you credit the equity with the same amount. How much will be credited to equity? Accumulated equity. We have to accumulate the equity. That is why I put accumulated equity. 212,500. You've debited the expense with 212,500. Then you've credited the equity with 212,500. Then you also have year 2. Year 2. So we have December 31st, year 2. Expected outcome. Expected outcome at the grant date. Grant date. So, you have 500 employees. Then, of these 500 employees, if you look at the second note, note 2, you were told at 31st December year 2, if at that date, SPSC expects 88% of employees to still be with the company at the end of the vesting period. So this is the vesting condition, having 88 employees to still be with the company. You have 500 employees, then 88% is expected to be with the company times the vesting, share option. We have 100 share options. 100 share options. The market price is $15. This is the second year of the 3 years period. So we have multiplied by 2 years out of 3. So this will give you the cumulative amount. I've told you that it is the accumulated amount that will appear as an equity for the period. So you have 500 times 88%, that gives us 440, times 100 times the market price of 15, then times 2 divided by 3. That gives us 440,000. This 440,000 is the accumulated amount. And I've told you that it is the accumulated amount that will appear as an equity. Now, remember 212,500 have been expensed in the year 1. Then the amount expense, less expense in the previous year. Less amount expensed in year 1. So the amount that have been expensed in year 1 amounted to 212,500. So I've told you this appears as an expense. 212,500. If you remove 212,500 from 440,000, that will give us the amount that will be expensed in year 2 minus 212,500. Then you get 227,500. This 227,500 will be expensed in year 2. Charge in year 2. year 2, or amount that will be expensed in year 2, we have 227,500. I've told you the accumulated amount will appear as an equity in the statement of financial position, and the accumulated amount for the 2 years period is 440,000. Then we have accumulated equity, and that amounted to 440,000 for the 2 years period. 440,000 for the 2 years period. Then the third year, we have year 3. Year 3. So December 31st, year 3. So, and the expected outcome at the grant date, the expected outcome at the end of the year 3. So you were given the vesting condition. You were told 31st December year 3, if at that date 44,300 share option vest, the share option that vested at December 2020 year 3, you have 44,300. 44,300 vest. Now, this is the cumulative for 3 years multiplied by the fair value, which is the market price, $15, times 3 years out of 3 years. This is the 3rd year. This is the total share option that vested in year 3. So 3 years out of 3 years. So we have 44,300 times 15 times 3/3. That gives us 66. So you have 66. This is dollar. 664,500. This 664,500 is the cumulative amount or accumulated amount that will appear in equity. Amount that have been expensed in the previous year, less the expense previously recognized. Amount expensed. Amount expensed in previous year. If you look at year 1, 212,500 was expensed. In year 2, 227,500 was expensed. If you add the 212,500, which was expensed in year 1, 212,500, which was expensed in year 1, and 227,500, which was expensed in year 2, the total amount expensed so far would amount to 440,000. So less the 440,000. 440,000. So if you subtract the 440,000 from 664,500, then you'll be left with 224,500. This $224,500 is the amount that will be expensed in year 3. That is the charge in year 3, or amount that will be charged in year 3 as an expense. And I've told you that the accumulated amount will appear as an equity. We now have accumulated in equity. Accumulated in equity. The accumulated amount is $664,500. $664,500. This marked the end of the solution to the question. In my next video, I will examine equity settled share-based payment with performance condition. Please drop the love emoji, like the video, also share it with others. Thanks for watching EZIKAN.